Hey everyone, welcome back to the Daily Gold Podcast. Dave Skarica of AddictedToProfits.net joins me today. And Dave, what a last few weeks that we've had in the markets. We talked about how the precious metals were holding up very well, but it just seems like you know that something is really wrong when you suddenly start to see precious metals just getting thrown out like we've seen the last couple weeks. And I know there's reasons for that, but I mean, it seems a little bit similar to 2008. There's probably a little bit of forced selling there. What do you think?
Well, you look at today, for example, we're speaking on the 30th of September. What's today? It's the last day of the quarter, and the stock market really, the S&P really tanked into the close. And I think, obviously you have some window dressing where people don't want to look like they own stock, so you get that. And with precious metals, I just think it's almost like you're a victim of your own success. That number one, let's face it, gold was overbought. You and I in our podcast is we're looking for some form of pullback. Maybe the pullback was a little more sharp and severe than we thought. But it's like if you're a hedge fund manager and your third quarter is horrible, and most of these guys are going to be down between 10 and 20% for the third quarter, and all of a sudden that in October till mid-November, there's a 45-day period of people put in their redemptions. You're going to get massive redemptions. Well, what do? You have to sell to raise cash. And what do? You sell the positions that have made you money. So you're selling your gold and precious metals. You're selling your gold equities. And unfortunately, like I said, they become a victim of their own success where because you can get more money for something that's up 30% than something that's down 50%, then you just sell that. And then, of course, then you run to where the CME has upped their margin requirements a couple times in the last month. So that adds more forced selling. And then, again, if people are getting margin calls on, a Dow or NASDAQ stock that they own, maybe if they own gold, they got to sell gold to pay for that margin call. So it all just becomes this like snowball, which rolls downhill. But the good thing is, number one, it fits into what usually happens seasonally. Seasonally, after you kind of get this rally into September from the summer lows, you usually then get a pullback into November. I think this year's pullback just happens to be a little more violent than usual. And then you set yourselves up for the really good November to March or April run. And I think that's exactly what we're seeing. Like I said, it might be a little more violent, is that both the gold and equity markets probably will bottom by sometime in November, and then you're going to see a big, big move up in gold going forward.
Okay, so bottom in November. I mean, personally, I think we're, generally speaking, we're probably about 75 to 80% done with the sell-off. But given the short-term technical damage, I think it's going to take a couple weeks, for these markets to kind of bottom and then establish a base before they can start moving up again. So is that kind of what you're thinking with gold, where you're talking about November?
That's what I'm looking for. Like I said, okay, let's say we've had a $300 drop from 1900 to 1600. I would agree with you that the ultimate low I really see is about 1500. So you're 3/4 of the way through that. So like when I'm saying November, I'm talking timeline. Yeah, I think percentage decline and the stocks, for example, look like they're basing. The HUI was actually up a little bit today, despite the Dow being down over 240 points. So I think that you're done most of the actual selling in terms of percentage terms. And it's more just like backing and filling and basing until the next big move higher here. And I think one thing that's really going to launch it is, and maybe I'm the ultimate contrarian when I speak like this, is I'm actually looking for some kind of short-term solution to the euro debt problem, like the euro banking crisis. And when that happens, what I think happens is you get actually a huge rally in the euro vis-a-vis the dollar. Could drop a little more in the next couple of weeks, but then you get a huge rally and you get a big tank in the dollar, and gold really begins to move on that.
Yeah, I mean, and you look at the situation in Europe, and they're kind of having their own version of what we had in 2008.
Exactly.
But the ECB is just going to have to come in. We know that the Europeans are more worried about inflation, and obviously, some of the talking heads over here, they like to criticize Europe for that. But I mean, let's be honest. What are they going to do? There's going to be massive defaults and bankruptcies unless the ECB
comes in and starts guaranteeing a lot of these bad debts. And they're just going to have to do that. And Dave, do you have any idea when that might happen, and at what point will the markets react positively to that?
They're already talking about some kind of, solution happening, in the next 3 to 4 weeks. I would think it's going to happen by Christmas, to be very, very conservative on it. That that they basically, as we both know, it's a banking problem. It's not really about Greece or Ireland or the pigs. It's about the banks. And if you get defaults, then the banks are essentially bankrupt, like the U.S. banks had their problems with the subprime in 2008. And if that happens, you don't have any loans of money, you have destruction of capital, you basically get this spiral downwards. So it's really backing up the banks with capital becomes the problem. Because if you actually look at European interest rates, look at Spanish rates, look at Italian rates, look at Irish rates, they're all, like Irish rates are hitting multi-month lows. They're all coming way down off the highs of summer, which tells you that the market is probably saying that, yeah, these austerity programs are moving along, slowly but surely. And really, Greece is the only one that remains the basket case. So I actually disagree, and people try to blame everything that's going on in the market on Europe. A lot of the things are telling us that really that's not as big as the problem as the market is, or people are perceiving it. I think another problem with the market, and this may be the bigger problem going forward, is there's really no plan in the United States to get back to some kind of growth in the economy and to tackle the deficit problem. And as long as long-term rates go lower, it's like giving a drug addict needles or giving him a free apartment next to the coke dealer down the street. It's not. It's feeding the monster. It's like the government can still be as reckless as it wants fiscally because it's getting to borrow between 0.5% and 2% between 1 and 10 years. So as long as that stays low, you're not going to see any solution to the fiscal or economic or jobs problem because it just allows the government to putter along, and then that also is negative sentiment in the stock market. But I think gold can go up and gold stocks can go up in that environment if we get a solution to this euro banking crisis. So I see a solution by Christmas, and then we'll just have to go from there afterwards. Because the way we're going along now, I keep telling everyone, I rather have gold at 16 to 1700 and the markets really stabilize than gold at 2500 and the S&P at 500. Because in that scenario, the gold equities aren't going to do anything. And I am much more interested in the equities than the actual bullion at this point.
Yeah, I mean, that last point, I completely agree with you on that. And I think that's what we're going to see because, as we're talking about, this is a kind of a repeat of 2008, but on a much smaller scale. And so what happened after we had some, intervention stimulus to kind of stabilize things is, initially we saw precious metals did really well. Then, when we got to, early 2009, remember gold put in a top, but the gold stocks continued to go up even as gold didn't go up. I mean, that lasted for like six or 9 months or so. So, I mean, and given the fact that the large stocks have actually been fairly stable, they haven't been technically broken like a lot of the smaller stocks. I think that's possible, what you're talking about. And also, the juniors are not going to do well when the stock market is falling precipitously. I think that's another point you agree with.
Oh, totally. And that has actually been one of my biggest. It's terrible to be right about the macro trend and then long about your actual investments. Like, you look at the CDNX, it closed at 1467. I know there's oil and other stocks, but that's still the only kind of real gauge we have of junior, like mining stocks in general. And whatever, I'm interested in junior oil stocks too. So, but that essentially began to move at last July at 1342 and went to 2400. It's essentially erased all of that move higher, despite the fact that silver is still $30. Gold is over $1,600 an ounce. So the juniors are near their lows of 2010 when both of